Let's bring in Julian Emanuel from Evercore ISI, Brent Thill from Jefferies, and our own senior markets commentator, Mike Santoli. Julian, any reason to think this is more than just a bounce off of very oversold and very hated bear market conditions for tech?
Well, there's really a lot of things going on here, Sarah. Number one, over the last day or so, the yield in front of the Fed tomorrow has stopped, skyrocketing higher. Basically, we're expecting, the market expects 7 hikes in 2022. We're looking for 6. I would argue that given the sell-off in the commodity markets, there's a little less fear of inflation. And when that's the case, the natural inclination is to go towards the growthier sectors. And, even a place like China technology stocks is so oversold that a bounce is vastly overdue in our opinion.
Brent, how much do your clients hate the stocks that you cover right now? And is it enough to make you interested and to look to buy because it's just gotten so negative?
Yeah, I'm the fat kid on the playground right now. We're at a 10 of 10 on pain. Our desk continues to see a lot of negativity. We've seen cash levels go to the highest levels in 5 years. And we're not seeing any buyers on our desk at Jefferies right now. So I think it gives you a sense that this may be a more bullish sign, to Julian's point, that we may be vastly oversold. But obviously, it's hard to factor in what's going to happen with the Fed on Wednesday, what's happening in the unfortunate situation in Ukraine, and in the hangover of all these other factors, and the economy potentially slowing. But I think a lot of this is now in. You look at companies like Facebook at 13 times earnings. Maybe there's some downside, but at 13 times, I mean, you're not taking a big risk with a multiple way below the market.
Facebook or Meta is barely rebounding, Brent. It's still near the lows. So of all the stocks that you cover, which valuation looks most enticing? You mentioned Meta. Anybody else?
I think other great companies like Adobe are starting to look more interesting. We think trough on Adobe's 370. So that's getting closer. Certainly a phenomenal franchise on that side. Microsoft is still a great story that's going to grow, mid-teens with great earnings leverage and a phenomenal management team. So we like the Microsoft story. There's a handful of small and mid-cap names that we think now are trading below takeout valuations. So what's even more interesting is small and mid. Those names right now are trading well below trough. And
like
we're
what?
seeing, companies like Vimeo, VMEO. You look at some of the multiples across SMID, these multiples don't make any sense. Private equity is going to start getting excited. You look at, historic software M&A at 8 to 12 times revenue. You've got most of the small and mid-cap names trading below those ranges. So, again, a lot of the bad news is baked in. I think the only concern we have now is, are we going to see fundamental weakness? We have not seen that in tech. We've seen everyone say things are phenomenal. Everyone came out of Morgan Stanley's conference and was like, no one's showing any signs of weakness last week. I think that's the concern now, is do the rate hikes and some of the overhang of what's going on in Europe have some fundamental impact. We haven't seen that yet. So that's the only big risk I would call out that we're keeping an eye on. But we have not seen we've not seen that in numbers yet.
No fundamental slowdown. Mike, on the valuation point, Brent says that the valuations look enticing. They look good here. Is that true, or were they just way too inflated last year and during COVID when they got very sky-high multiples? Some of these companies, multi-billion-dollar companies with $100 million revenues.
Both those things can be true. They were way overinflated last year, especially on the smaller side, and they're becoming more reasonable. And yes, when prices come down, when valuations come in, risk goes lower, not higher. If you look at the overall NASDAQ 100, which of course is still unduly influenced by the very largest stocks, it's gone from like 31 times forward earnings down to under 23, like 22. Its premium to the overall market is back roughly in the zone where it was in 2018, 2019. So it has given up that entire pandemic era kind of excess premium that was built up. I think you could say that. I mean, Apple, again, it's under 25 times, but it used to trade, well below that. So I think it's still up for debate as to whether, as a group, they're cheap, but they are cheaper. And if overall earnings growth for the S&P 500 is considered to be at some risk, usually people latch on to some of the predictability.
Well, I think if Scott Minerd is right, yesterday at Guggenheim, he said if yields peak, then tech should be a buy. And that, we're seeing yields come down. That's a key factor.
And you could argue it's under-owned or getting there.
Sure. Brent, Julian, Mike, thank you all for joining me.